So this is the second episode of trading news. We don't really have a show title for it. As yesterday, we're here with Harry Daniels from Live Squawk, the news squawking service, and we're going to be going through some of the stuff that's happening in markets. It's not as exciting as it was yesterday, but it's still enough to talk about, right?
Absolutely. Yes, I do think there are bits and pieces, but it has calmed down. I think over the last 3 or 4 days. Today's a more stable environment today, I think.
Yeah. So what are people caring about, or what are you caring about?
Well, in terms of the news focus today, with a day to go before FOMC, the US Fed's rate decision and policy meeting, which starts today, by the way, but it's a 2-day meet. And finishes tomorrow. I think the reason we've calmed down, a couple of reasons. Firstly, Turkey rate decision and MPC meet tonight has calmed markets down. I mean, there's a general expectation, as we mentioned yesterday, of a rate hike by some 50 to 500 basis points sort of range out there. And that's helped calm the markets. I think moves by India, they raised rates to help the currency, support the currency. That's also, it was a surprise move. That's also helped, I think. And also, as we head into, for the Asia players at least, we head into the China New Year, Lunar New Year. We're going to start seeing some easing off, really, I think, in the volatility in that sense, and the sort of directional trading that we've seen. You've got in UK and Europe, really, we're looking at GDP today that saw 0.7% read on the quarter over quarter, which was in line with expectations, really. 2.8% on the year over year read. A little bit disappointment seen for sterling on the back of that. I think a little bit surprisingly, because maybe after the sort of stellar numbers we've had in the last sort of quarter of last year for the UK economy, people are now overreaching and over expecting in terms of the health of the UK economy. So that's really been what we've seen today. A couple of auctions out of Spain and Italy that have gone down without too much incident, really. And moving on to the US, with the markets, the bond markets, generally speaking, have been on the softer side. Yen and franc also have lost out today on the back of the fact that there's a bit more risk on trading, if we like that phrase. Really, and that takes away some of the need for the safety play. So bond markets a little bit suppressed, underperforming today, as they are on the back of a bit more confidence returning to these emerging markets and risk assets. As I said, a major part of what we'd like to see will be sitting on hands, if you like, from big participants, market participants, ahead of tomorrow's FOMC, where the general is Bernanke's last meeting as chairman on the Federal Open Market Committee, and he's likely to signal, again, the consensus is he's likely to signal for another reduction in the Fed bond buys by $10 billion to a total of $65 billion. And we're expecting that to be evenly handed out between the mortgage-backed securities and the government bonds. So again, anything other than that would be a bit of a surprise, and that's very much factored into prices that we're seeing at the moment. And it was up until the emerging market situation last week, and we may see a further. So it's not advice; it's just my opinion that we may see further softening in bond prices on the back of that, and also on the back of supply from the U.S. Treasury. So overall, yeah, I think a reduction in the bond buy is expected, really, and a bit more of a forward guidance update on forward guidance. I think could be expected as well.
So I'm playing around with this new tool I recently had
Hmm.
to build on your assessment about FOMC. I just wanted to show you. Do you see my screen?
Sure. One sec.
Do you see it on
Can I
Skype?
see your screen? Not at the moment. No.
No. So this is a tool. I'm just gonna show tool I showed in the previous segment as well,
Sure.
where it's a way of analyzing data using basically simple quant tools. So you're
Right.
analyzing. So I'm using
Oh,
SPY.
I see it now.
Yeah,
Yep.
I'm using SPY and I'm plugging in FOMC meeting announcement, and I'm just doing the analysis period of -2 days. So the 2 days leading up to the announcement, and it's drawing up charts based
Right.
on how markets are most likely to move.
Right.
And it seems that the most prevailing pattern, which let's say the inside the middle of the bell curve, is a sell-off,
Mm.
and I guess today I just gotta check markets right now, and well, it's a little bit up. So do you think that the times are changing? Do you think that there are because of we're entering a completely new period, you have to kind of change the rule book? Do you have to change like how you approach a news item like this? It used to be good news is bad news, and then
Yeah.
all of a sudden now it's, well, bad news is actually pretty bad.
No, I get your point, and I totally, I do agree. I do think there's again, as we start the market start to recognise what the central bankers have been saying all along, that tapering isn't tightening. This is because there is good news out there, because the economy is moving at a stronger pace. They have the confidence to take away the crutch. From these extraordinary measures that they've put in place, I think that's how you should take courage from that. You should take encouragement from that, and should see that as a positive. The thing with markets, they're kind of warped. They'll try and push you one way um, before pushing you another, and sometimes it's a bit of a head fake in terms of where you see markets go in the reaction to certain events, because they are, some of the bigger players actually try and get you into thinking. It's not as it seems. So, yeah, I do think in this instance, though, that you should start looking at 2014 and the new Fed chair being one that's going to take us into a new phase of the recovery phase, the global recovery phase, as the US is a major part of where the global economy goes, if you like, and you should start to take some encouragement. I do feel, with the earnings that we've seen so far, that and the lowered projections and lower forecasts from some of the earning estimates that we've had, that it's a longer and rockier road than people. Some people out there think it will be, but ultimately we are seeing an improvement. We are seeing a turn up in some key sort of metrics, and take that as a positive. And rather than I mean, I'm a glass half full sort of person, but you should take
Mm.
those as they are, and look for further signs of improvement. This emerging market story, as much as it's moved the markets, has been an excuse for those who are long, I think, the risk assets to sell out and take a bit of money off the table. It's also a good reason to try and, I think, for others to look for levels to buy, really,
But
and
you
that's
talk
what we're
to a
seeing.
lot of traders, don't you?
Yeah, yeah, for a amount of
W-
traders
Are
over the
people
course of
still
the day.
bullish? Because I have this like sensation that everyone is this almost uncomfortable level of bullishness at this point.
No, I mean, it depends on the sort of level of trader you're talking to. Most of my day trader clients um, would love to fade a move like this. They go counter. They're counterintuitive. They like to fade rallies. They like to buy into dips. And what's really sort of caught a lot of these guys out really is the strength of the move that we've seen over the last 18 months, I think, in the equity markets and the stock markets. So I mean, it's a welcome opportunity to sort of see things go maybe the way they should go, in a fashion, with this emerging market story, and the negativity it's brought on, and the forcefulness of the selling that we've seen. It's by no means a big run on it's not by a big run on equity markets. It's not a sign of or lack of confidence in the markets. It's just simply we've come to a level where people are now happy to sell it and happy to sort of not buy it, if you like, and we'll wait, and we'll wait for better levels. But I still think the buyers are still king. Bulls are still kings in this market in the medium term, and they're just looking for better levels to get in.
What do you think? Because judging from the sidelines, it could easily be dismissed as being a very simple market to make money in the last 12 months. But
Yes.
interestingly enough, traders I talk to, especially with the equity bias, appear to have
Yeah.
none of them made money. And is this a remarkably hard market? How's your perception of this?
Again, in terms of the timescale of the trader you talk to, I think there's been opportunities there for sure, and I think the sort of run up in the stock markets we've seen for um, maybe the very short term traders, they don't necessarily like the some of the moves out there, but they've made money for sure. I mean, others, I guess. have been trying to fade this move for a while now, and have been caught the wrong side and been squeezed on it. But I think it's been the trend's been there long enough for those to become accustomed to it and generally sort of feed off it and make money out of it. In the the circle I sort of talk to, it wasn't a great year, but I think people made money.
So what's the trade du jour? So yesterday it was talking about fading the yen move, which turned out to be an excellent trade.
Sure.
And but then again, I mean, people have been long dollar yen for a very long time, so it's not a surprise that everyone tries to fade any move, any fake back, or like you said, the head fake.
Sure.
But what else are people talking? Are people more bullish EM, do you feel, or
No, I think there's still more to run on that. I mean, we'll get more following tonight's Turkish central bank meet. Really, we'll hear more from the likes of Brazil, more from Russia. The Ukraine situation seems to have improved a bit. I'm not making any calls on that because that's a still very volatile situation. But
But then again,
um,
that didn't move markets much. I mean,
no,
it's on a human level, it's horrible, and
yes.
what's happening. But on, I mean, if you're gonna be cynical and think about markets, I mean, the Ukrainian situation is, other than natural gas, it might have been part of the natural gas move, but I can't really see much market moves from
Well,
that.
I take it as a part of what else we've seen. It happened at the same time as we were getting disruptions, the political disturbances in Turkey, which have got to, you could take the Syria talks last week as well, and the arguments around that. It was all part of a collective sort of issue that we had around emerging markets, Eastern European economies at the time. So in that context, I think the fact that that's now looking slightly better than it was is not a bad thing. But yeah, you're right. It's a very insular sort of issue out there, and didn't have much of a ripple effect over the bigger picture. But I think anytime you get conflict, people keep one eye on it and try and understand what's happening, and it makes people nervous. Uncertainty makes markets nervous. That's a general sort of rule, and people like a bit more certainty out there. And I think we may get that. We haven't had elections yet, so that's one to watch in that sort of region. But um, I think the trade du jour today. I generally think people will sit on their hands and wait for the Fed tomorrow. I think we had
So
burgeoning
fading
supply.
volatility, maybe.
Sorry.
So fading the volatility move, possibly.
Yes, I think there's a touch of that. I just think with the bond markets here, U.S. bond markets especially, there was a big risk on play. Risk off play. So I think we saw that flight to quality, flight to safety, and I think that's now you've seen that start to reduce, and people pair their bond buy at the moment. There,
Yeah.
because there just isn't that particular need right now. So I think if anything, bonds, watch the maybe some keen selling side interest in the bonds with the FOMC coming up tomorrow and preempting what they're likely to do with that. But
Yeah.
a fairly sedate day, I think, today.
Speaking of bonds, it's kind of an interesting trade. It's one of the best trades in the world to it's possibly the best to short stocks and go long bonds. And the U.S. Treasury was possibly the most hated asset coming into the year because incredibly bullish year. Everyone is certain of tapering. Everyone feels like the everything's been written. But as
Mm,
far as I understand, the majority of people, and I'm including high level economists here,
mm.
from very big name banks, doesn't appear to truly understand how tapering works and how subtle these moves can be. And judging by the last, let's say, 30 days of treasuries, economists were on, and people, it was probably underpriced. I don't know about now, but what are you hearing about this?
What on the well, in terms of the bonds, I think um, I think people are right to be nervous when we reach sort of key levels on the US 10 year. I mean, we're trading at the moment. I get up a 10-year yield at the moment, which is trading around 2.77% here. We're expecting this thing to be about 3% plus round about now,
Yeah.
and so I think it's taken a couple of people by surprise. But as I said, whenever there's a situation that we've had where a trifecta effect where we've had like sort of the Ukraine situation, we had the Syria argument going on, we've had maybe the Turkish situation there as well. That the bonds are still very much the safety play. You run to bonds, you run to yen, you run to francs when things get a bit rough out there. And I think people are nervous with sort of stock markets at these multi-year highs at the moment about the direction that they'll take. And I think it was only natural that I think that you'll find some safety in bonds. We're still likely to see 3%. Rather than 2% on US 10-year yields in the near future. I'm being a bit facetious
Maybe
saying that
this
with
is a more natural
2.78, but
level, though.
sorry.
Maybe the 2.7, 2.8 is a more natural level. People
Uh,
gravitate towards big numbers, but
Sure, I think we've been through it enough times. I think we've been back and forth through 2.75% yield, so I don't think that's an issue.
yeah,
But I do think 3% is a psychological level, and once we do get above there with any kind of um, volume, then I think you'll find some new levels for the treasury to trade. And again, it shows signs of recovery. Bond yields rising to those sort of levels show a growth picture, a better growth picture, which is what we're looking, what's being forecast for the year. So I fully expect us to see 3% again in the near future. All sort of disruptions being aside, and moving on from there.
yeah. So, is there anything you're going to be watching today concerning the FOMC? Is there any expected changes of estimates or anything similar, or is it just like you're going home early and and you're gonna take maybe go out buy some ice cream or something? I don't know. What do you do on a day like this? On a like a
You wait and watch. You mean what I was told as a trader was you keep your bullets dry. You wait until there's an event worth trading,
yeah.
really. And I said
But
that we're in
also
limbo.
from your perspective,
From my perspective, we're always alert. We always look for the next potential issue out there, or theme. And I think, as I said, FOMC is it, and we'll talk again tomorrow on the second day of their 2-day meeting, and with more views formed about what we're likely to see. But at this time, no one's really expecting anything other than a $10 billion taper. It's Bernanke's last meeting. He won't want to rock the boat ahead of Yellen.
yeah.
It's her Fed. It's her Fed now. It's her FOMC. So she'll be the one making any new direction or new policy statements, I think.
I mean, I'm supposed to know this, but are there any quarterlies that are coming out now? Financials from important companies. I'm just looking it up right now. What are you
Um,
gonna be? I mean, I know you know this by heart, but I don't.
You think so? But we've had the likes of Pfizer out today. They've been a beat. Forward numbers were actually quite good today as
Yeah.
well. So in that instance, I think we've had some good companies heading into the cash open. We'll have a look. We'll see some positive reaction. I think Europe's been fairly steady today, and that should provide some support for equity markets
Oh
out
yeah,
there.
it's
Uh,
incredibly stable now.
yeah, I mean,
And
we got durable goods out in a couple of minutes,
yeah.
so we'll see where that brings us. It's a volatile number traditionally, so we're expecting a 1.8% rise from a 3.5%. 3.4% number last time round. So we'll keep an eye at that and see if that provides any further signals or gives us the market any sentiment towards this week's FOMC.
Brilliant. I think we can leave it at that. I want to thank you for. It was about 20 minutes. I think that's an okay format, isn't it?
Yeah, I mean, I'm a bit tight for the durable goods number, but I'll make
Okay.
it.
So then I suggest everyone go to livesquawk.com and sign up, at least for a trial or a service, and check it out. I recently discovered them and contacted them, and that's the reason why we're here now. So it's not them contacting me, it's the inverse, because they're just a very good service. And yeah, you should really check it out, and hopefully you guys get some new subscribers out of some attention. So we're gonna be doing this every day. Eventually, once we get the rhythm right, it's gonna be a little earlier in the day. But right now, we have to iron out problems. So we're closer to the U.S. Open than the European Open, which is, I guess, easier for all of us. But anyway, thank you, Harry, and talk to you tomorrow.
Thanks a lot.
Cheers. Bye.
Cheers. Bye bye.